Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you again on PVN Network. Today we're going to touch on the EIA and talk about what is actually happening across the numbers as they were reported today and what this means for the coming few weeks. So let's just first, touch on what happened in terms of total oil. Now, the headlines are obviously wrong because they're written by algos, so they're still not looking at the right area, but you really need to focus on the aggregate with the SPR, because the SPR, or the Strategic Petroleum Reserve, has been rented out by the government for a 2 to 8 month period, depending on what the contract looks like, how long you need it for. So the total build was actually 6.31 million barrels. And the big focus now is, okay, well, Pad 5 and Pad 3, you still have a ton of tankers sitting out there waiting to unload, but the congestion is problematic. These are things that take time. So even though the actual storage is showing something of a decline, specifically in Pad 5, we know that there is still more to come and that there is not so much a draw as there is just a timing delay. And then the other big focus is Cushing. So Cushing is now at a little over 2 million barrels, getting to that 65.4. Now, the quote unquote magic number is 76, but a lot of that difference has already been given out. So even though it looks like it's available, it's already been spoken for, which is why we've started to see these production cuts start to ramp up. So now, what does that mean? And now we turn to, well, what did the refiners do, and what are the runs? So here we had the crude runs from the refiner perspective increase slightly. Our range is between 70 and 65. So right now we're at the top of the range out of about 70% utilization rates, which equates to about 13 million barrels of throughput. Now, the big focus has been the increase in Pad 3 and Pad 1. So Pad 1 should see relatively stability here, but Pad 3 should start to pare back a bit now that you have some new announcements of cuts of some of these runs. Now, the big focus is, well, when are they going to adjust? Are they going to increase for their typical driving season as they ramp up in the summer? And the answer is going to be no. We think that you'll probably get a little bit of an increase, but on a seasonally adjusted level, we're not going to see the same kind of throughput, because even though gasoline, which we'll talk about in a second on a different chart, even though gasoline is showing something a little bit better, it's really nothing to write home about. And that's what's going to bring us to the implied demand. Now, the implied demand is a number that's calculated, so you have to appreciate what it is. So here you have the implied demand for gasoline increasing, but if you look at it from a year over year and 5-year level, you can kind of get an indication of, we just went from a terrible number to just a bad number. But the big focus going forward is going to be distillate, because distillate is where the rubber meets the road on the global economy, specifically, the US economy from this perspective. So when you look at, okay, well, what's distillate doing? Well, distillate has had massive builds, and the builds are only going to continue because refiners have been focusing on the distillate cut. And at the same time, so jet fuel originates from kerosene, that kerosene can be blended into the distillate barrel. And the reason why that matters is because gasoline, which is near or at tank tops, depending on where you're talking about, and the jet fuel are near tank tops, so you have to adjust. You have to get things to be a little bit different, and distillate's going to be the focus. Not only because it's going to show you how aggressive or how much better the economy is getting, but it's also going to be indicative of how quickly are we going to absorb some of the spare capacity, and the refiners are going to have to focus on a reduction. So here we have exports. So exports are a big problem because we have more Latin American countries canceling cargoes through June. So as you have them wrapping up through June, you're going to get a lot of these barrels that should be going into Latin America, into Europe, getting pushed back. So at the same time, you have Europe, which is increasing the amount of gasoline coming into Pad 1 or the East Coast, as we've had a little bit of a reprieve in terms of storage. So that's attracted some cargoes away from Europe. That's only going to increase as African demand has continued to drop. Storage is increasing exponentially from the tanker level. So Europe is going to essentially dump that and direct that into the US. So as we look forward, we expect more builds. Distillate is going to be the focus, and we expect more builds in distillate, specifically because jet fuel doesn't have any demand for obvious reasons. And that's only going to increase into the distillate number. So Cushing is where to follow. We think that the crude rally has had a nice run, and the curve is going to start to pare back at this point. Now that we were getting some of these earnings reports, we know E&Ps are starting to cut, and that's already getting priced in. So, the big focus is going to be distillate and PADD 3 as we go forward. And really, what does that implied demand and export market look like? Now we just need to focus on exports in the global market. So let's just touch on, because I talked about the U.S. exports being cut going into Latin America and also into Europe. So the issue is going to be, how long is that going to last? And we think this is going to last a significant amount of time, because Brazil has also done a big about face. They've actually increased their oil production. They've offset some of the cuts that they've talked about, and they're keeping their refinery, the refiners utilize about 79%. And we know that there's very little domestic demand. So all of that's going to go into the market, which is going to keep some of our exports low, which we saw this past week, down by about 1 million barrels a day from the products point of view. Even though we had a little bit of a tick up in oil exports, that's something that will also come off and fall below 3 million over the next 2 weeks. So now when we look at, because everyone keeps talking about OPEC cuts became effective. Well, let's look at some of the Kepler data that just came out, and you can see that tan line, which is 2019, and the black line being 2020. So even though, yes, we've had a cut, not saying we haven't, but we're just back to where we were last year. So being back to where we were last year does nothing if you factor in the amount of demand that we've lost just based on refiners not operating, petchems not operating, global storage being full. India has already talked about how they're sitting there and they're storing more and more crude offshore because they're tapped out across all of their tanks, whether it's at a refiner, a tank farm, or their own strategic petroleum reserve, which means that there's going to continue to be some pricing adjustments. There's going to be more cuts in terms of the official selling price and also market share. So China has taken a record amount of Urals, which is very important to consider that, when you look at this Kepler chart, you really get a sense of, well, that was Saudi's area. Like that's their market. They were focusing on it. Brazil sends about 60% of their oil into China. And now you have Russia trying to take that market share. Saudi responded by taking Belarus, which is interesting in its own right from geopolitics. But the focus is now, where is the oil going to go now that there's a lot of storage that's been used up? And you're seeing this slow steaming. And by slow steaming, I mean, if something can operate at 18 knots, well, let's run it at 12. And if I can go through a canal and get there faster and pay some tolls, or I can go around the Cape of Good Hope, well, let's just go the long way around to kind of space out some of these shipments. So when you think about Russia, Russia has, based on this chart, you can see the crude loadings overall have fallen by about 1 million. Now, there's a mix between both condensate and oil, but you can also see crude grades are getting cut in different capacities. So where are we seeing some stickiness? And it's in that ESPO and the CPC. And that's a big focus of, well, where is this oil going to flow? And that ESPO and Urals is going into China. Europe is taking what they can, but they've just announced a huge suite of additional refinery cuts. And by additional just means it's going to be prolonged. They're already kind of at this area where they can't really cut much more without shutting down the whole facility. So Russia is a big focus, but then you think about, okay, well, they're cutting oil, but seasonally adjusted now, they are at maximum diesel production. So as we've talked about distillate, as we've talked about diesel, they're pushing a huge amount of product into the market. Where is that going to go? And that's why you have to consider not just oil in the market, but you have to consider exports in the market, because exports overall from both refined products as well as oil, it can get very onerous. So now when we wrap up and we say, okay, well, why does this matter for the U.S.? And the US, you can see in terms of the comparison of the last few years, we're at total inventories of record levels across the board. And this is looking at it over the last 5 years because, you know, we've added tank storage, we've added capacity just because we have a huge amount of new production. So we need to account for that. You know, US, you know, gasoline inventories have to come back, but at the same time, the products overall keep building, and it's just because the distillate is the big focus. And you're seeing that getting reflected in some of the prices. So when you look at the two prices in terms of, in this one, it's diesel on a spot level. One is New York and the other is Gulf of Mexico. You're seeing that we're at I think that's the new low, with the low bar right down there, or the lower line is hitting 2007. So we're below where we were during the financial crisis. So you can see how this is adjusting, how flows are moving. Europe is trying to send out product. Boats are making big U-turns in the water, going to different places. And this is what we're trying to focus on, really calculate where are prices going, where are cracks going, where's the demand, where's the supply. And we can just tell you there's a lot of supply and there's not that much demand. So if you want to keep learning more, keep following us. We're going to be focusing on these things with different prices. We have a deep dive report coming out tomorrow, kind of tying this all together. So it's always a pleasure. Come back, subscribe, ask questions. And again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings with Primary Vision Network. Always happy to talk, always happy to follow up. Thanks again. Hey, Mark again. Here to tell you about two things coming out on Thursday. One is going to be another video where we look at Europe, European data, and China. And then another is going to be our insights, which come out every Thursday. Please click below to find out how to sign up for our insights. They come out every Thursday. We look forward to talking to you again. Thanks.